All right, good evening, everyone. Futures Brizio here. It is 7:30 p.m. on Friday, February 14th. Happy Valentine's Day. Hope everybody had a great day. And just going to do a quick live stream here. And let me just open this up here. Sorry, I should have done this before I started the stream. But we're going to move this over out of the way. And then we're going to go back over here. Bring my platform back up. Okay. All right, so I hope everybody's doing well. Before we get started, as always, make sure you smash that like button. Subscribe to the channel. Any questions, comments, leave them down below. And we will get going. All right. So, as you guys know, I trade pretty much simple price action and market structure type stuff. And but I've been asked, you don't use any indicators at all, and generally now I don't. You can really just look at a market, and if you're experienced enough, and just say, obviously you can look at a chart and know, is it trending up, is it trending down, but more importantly, can you identify swing points of where you might want to enter. And so this is a simple trend following that uses price structure, market structure, and just uses one indicator. In this case, is a 10-period simple moving average. And it's a great trend following system, but it, like I said, it does still incorporates key swing levels, market structure areas for management and for, kind of warning about potential changes in direction and sideways markets and all that stuff. So it doesn't rely exclusively on the moving average of a trade. And that's what this is. So I'm just going to run through using this on these 5 Forex pairs I follow and a couple of futures markets, and just, let you see it in action and just kind of describe it. Now, you can, of course, adjust the moving average, and you might have to depending what you're trading. I've looked at it on pretty much on these 5 pairs, and it works pretty well. Nothing's perfect. No indicator is. No system is. It's going to be times it's going to fail. You're going to miss a trade. You're going to get a false signal and take a trade and lose. That's going to happen. Doesn't matter. You're going to have losses. But the good thing about this is if you follow it and you're just very mechanical about it, you also can have some really good trades. And when you do have losses, and there could be times where you might lose a couple in a row on a pair, you might get a couple of false signals, but the losses should be small and your winners should be much larger. And that's, in the end, trading's a probability game, and that's how you make money. Your losses have to be smaller than your winners. Not only do you don't necessarily even need a winning percent. I mean, you can be profitable with a 30 or 40% win rate as long as your risk to reward ratio is such that your winners are that much bigger than your losing trades. And that's all you need. Okay, so you don't have to win every trade. You don't have to even win a majority of them. And this works, any trend following system is going to work well when the trend is clearly there. Where it's going to fail and you're going to experience losses and you might not notice it right away is when the market starts ranging or consolidating. But what I mean by not noticing is that the market could start ranging, consolidating, and you might not know it out until you take a couple of losses. And then all of a sudden the price action starts playing out and you start to see the picture of sideways price move, and you're like, oh, okay. And then you can just kind of like put that asset aside and wait until, it straightens out and starts trending again, however long that takes. But like I said, you might take a couple of losses in the meantime. And unfortunately, again, that's just part of trading. Nobody's got a crystal ball to know when it's going to range. No one's got a crystal ball when it's going to break out. You just have to look and see what's going on, and at some point it will, and then you can start trading it again. In the meantime, you take that asset, you put it on the back burner, and you just leave it alone. Check it every day to see what it's doing, but don't sit there and try to dream up something that isn't there. All right. So let's just jump right in. Again, 30-minute chart, 10 period, simple moving average. That's all it is. And you can play around with the moving average type, length, depending on time frame, depending on asset. Okay. I'm not saying there's one universal setting, but I found this works well for me. And I find the 10 period simple, not exponential, not linear, not anything else, works well. And I feel it works the best on this time frame, the 30-minute time frame, which is a nice kind of in between. It's basically, I guess you consider it's a day trading time frame, but you could swing trade off of this too. It's entirely possible to swing trade off of a 30-minute time frame as well. All right. So basically what we're looking at is so let's just start from like this low. Okay. So essentially every time price breaks below this moving average, when it's an established uptrend. Okay. So here we have, we're making higher highs, higher lows. Okay. Every time price breaks, okay, above, below here in this case, and you start to see some bullish price action back up again, right? Whether you want to go on the first bullish candle or you want something to close back above the moving average, that's your signal to go long. Okay, so here's a trade here, then price comes down. Okay, now here's where you start getting into potential issue with structure. We have one right out of the gate here. Okay, because now you can look at this, and I'll zoom in a little bit. Let's go back over here. Okay, and we've got this price level right here. Well, we can see that price is broken through here, and you're thinking, okay, well, maybe the range is, maybe it's now trading to the downside. Okay, so price comes up here. Okay, and then you wait, and then you go short, maybe in here, and then you go short, and maybe you're in profit for a little while, and then boom, you get stopped out. Price pops back through here. All right, with a really bullish candle, and your stop sitting up here, maybe you get stopped out, or maybe your stop's over here or up here. Hopefully it's not that far away, but maybe it's a little above here. You don't get stopped out. Price goes down again. You think, okay, we're back in the money, and then boom, it pops up again, and then somewhere over here you get stopped out. That's going to happen. Okay. Now you can also use a higher time frame. You can look at this area on a higher time frame. And say, what is price doing right in this area? So if we jump out maybe to the 4-hour chart, you can see we are starting to make a turn here back to the upside, but it's a little unclear at this point. This is kind of a transitional area. All right, so this is what I'm saying, that nothing's perfect, but I did want to show you that. Okay, so if we come over to here now, let's assume we know we're in an uptrend now. So we'll forget about this one. Maybe there's a loss in here, maybe not. But whatever. So you move on. Okay, and then we see this. You put your stop here. Okay, I suggest putting it either a little lower than here, because you can see why right here. This wick would have tagged you out. So either put it at the next swing, which would have been down here, or you just drop it a little bit lower, because you can see we've got a low here and a low here. They're very close. Chances are they're going to try to, pop this down here and sweep all this liquidity, which is what they did. So be careful with your stop loss placement. Again, we're on a pretty short time frame, so you should be able to give yourself a little bit of wiggle room. Okay, so price pops up, and then you hold this trade. It comes down. You go into a little bit of drawdown. Hopefully you don't get stopped out, and then boom, we have this break. Price rallies through. Okay. Now maybe you close your trade up here, maybe not, maybe you hold it, but let's say you weren't in it down here. Here's another opportunity, right? Price breaks below the 30, so you can get in anywhere in here on these blue candles. Maybe you wait till you break back above, so maybe like right here or right here. Put your stop far enough away. Okay, price chops around a little, and then we have this huge move up. Okay, and then we see this again. Price breaks below, we get movement down. Okay, so right here, maybe this is a false break, because price chopped through. Right here is another one. So again, stop loss placement is key, because you can see what happened. They dug down, they pulled in all this liquidity, and then we had this huge candle to the upside. Okay, I think this was, I don't know if this was NFP, or this was probably a news candle. Okay, so maybe you want to put your stop far enough away. maybe at the next lower time swing, which probably would have been right here, because this is kind of far away down here. All right, so you got to be careful with your stop loss. That's the one thing with using these shorter time frame swing points, is that they're going to be, hunting your liquidity, and it's going to be a lot harder to hide your stop loss on a short time frame. But you get the general gist. So now we have this area in here. Boom, price moves up. We go up, make this new high. Okay, so now price begins to roll over. Okay, and we start heading down. Okay, so now this is where we might hit another loss or so before we realize what's going on. Okay, so we have price come down here, break this low. Okay, come down here below, and then you see this bullish candle. Maybe you jump in long. You got your stop sitting down here. You get taken out right here. Now this should be your first hint. Okay, when you see these three bearish candles, 1, 2, 3 big bearish candles, that price might be rolling over. Okay, hopefully you don't take another loss here, but you might, because you see these three come down, then you jump in right here, price comes down, takes out your low. So I mean, I don't know how many times you have to get kicked in the teeth when you're seeing bearish, strong bearish price action and lower highs starting to form. Okay, so anywhere in here I'd be a little cautious. Now some people are going to say, well, you had a structure break, right here. Okay, you had to break a structure right here. But if we're following the system, okay, then this may not, actually be a structure point you're looking at. You're looking at this down here. Okay, so at this point, you can either just, put this one aside until it takes out this structure, and then you'd start trading it from this level, or you can just begin to see what is the price structure. It's starting to make lower highs and lower lows with impulsive moves down, and to say, okay, well, maybe we have broken structure right here, and that's it. Okay, so this area right here is a structure break on a shorter time frame. All right, so now we're rolling down, so we can pick it up from anywhere in here. We have this area right in here, okay, where price pulled back through the 10 period. All right, and then we get this close here. There's an entry here. There's another one here, entry here, another one here, entry, 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 all the way down here. Okay, and as the market closed today, maybe there'll be another entry, although we put in an equal low down here. So who knows whether this will, end up being something where we're going to turn and start going back up. And oh, hey there, Darius Davis, how you doing? Hope you're doing well. Just going over a simple, making a video on this moving average strategy. Like I said, I generally don't use indicators. I usually just use market structure, but there are a lot of folks who do like to put at least one indicator on their chart, and this is a good trend following system I use on the 30-minute. All right, so you can see just the moves all the way down. Now I want to show you one where right now this is probably not going to be a good use, and you can see it's the Swiss yen, which is one of the ones I trade, and you can see where we're trading inside of a range. If I can draw a rectangle that covers enough price action where I can see this sideways action right here, okay, this to me tells me that this market is in a range, and I'm not interested in this. So until we break through this range and start really trending better again like we were here, then this is one I'm just going to put aside. But if we come back over here, we can see right here, here's an entry here, right? Price is trending down, breaks through, trending down, breaks through, trending down, breaks through, trending down. All of these in here, like this one, this is just internal structure. So if I was in this trade, I certainly wouldn't be getting out, but this is not technically an entry, but it's an entry from back here, and you would have caught a nice run. Price breaks through again, okay, breaks back under, you get all the way down. Then right here, this is a great little, sorry, Darius, I'm just, the chat's on the other screen here, so I might be a little missing some of your comments, but I will try to stop and comment. I appreciate you commenting. You got into copper because of me? Okay, good. Well, I will talk about copper really briefly. So, yeah, it's not a really commonly traded market, but I tend to stay away from like NASDAQ and S&P and Dow and gold that everybody else in the futures market trades, and oil. Those markets are kind of like the euro dollar and the euro dollar of the forex market. They're they're very liquid, but they're highly manipulated. And there's such a large retail crowd that trades them that I just find them to not be very good. And I like to, at least for futures, I like to trade a little bit more odd things than all the common things. So glad to hear. Hope it's working out. So then we had a higher low put in right here. So we made this low, and then this is kind of a warning sign that price might change right here, because you can see we came down here, we came up, and then when we tried to come down again, we failed. We put in a higher low and then this strong bullish candle. So to me, this is a warning sign anyways of a changing market. And indeed it did. And then we can see the uptrend, and we follow that same pattern going up. All right. And we already talked about dollar yen. We can see that. All right. Euro yen is another one that's trading inside of a range. So euro yen is like Swiss yen. I'm not interested in trading this one right now. Okay. We just see this inside this rectangle. I'm not interested in this. And you can see the moving average cutting right through the price. So this is not an asset I'm interested in trading. You can just see the difference with, sideways contained inside of a rectangle. And we just don't know. Now, again, in hindsight, this looks like very obvious consolidation. But in real time, as it's forming, if you're looking for like down moves, you may get, fooled a couple of times, right? This one may have worked. You put in a new low, but it snapped right back. Then we had this one. You went short. Okay, price did not make a new low, and it snapped back. And to me, that would have been a warning sign already. But at some point, maybe after one or two small losses, you realize we're inside of a range, and you need to just step aside and not try to trade this while you're inside of a range. So I will wait until it breaks out of this range. And to me, breaking out of this range, it would have to snap through either this low down here or this high at minimum, and start forming a trend. And like I said, this is really the extent of this range if you want to capture these highs and lows. Okay, that's the range. And as long as it's trading inside of there, I'm not interested in it. So this is one I would put aside. But again, you can see on the way up, entry here, entry here, entry here, entry here, entry here. All right, just nicely trading. Every time it comes below the 10 period, you wait for a bullish price action back above, jump in long, put your stop at a reasonable place. Don't put it too close, because again, if you went in right here, you can see what they did again. They came down here. They know that people have their stop losses sitting right below this low. Look at this wick right here. They come down, they sweep everybody out, and then boom, they blast it to the upside. Be very careful where you put your stop loss. Don't be so cheap and you think you're going to get a sniper entry and a 1 pip stop loss. It's not going to happen. Okay. Look lower down the chart, go to a shorter time frame maybe, and look for another area like right in here, this wick. This could be a nice stop loss on like a 5-minute chart, and it would have given you trade plenty of room. Okay. So don't try to sniper entry these so much where you have your stop loss sitting in such an obvious place. All the big banks, all the hedge funds, big traders, they can see your stop loss. They know where everybody is sitting. They come down, they sweep everybody out right here, take out all these stop losses, grab all that liquidity, and then boom, this huge move goes up, and guess what? You're not in it. So don't get taken out like that, okay? It's not worth it. If you make a smaller profit because if your risk to reward ratio isn't quite as good, that's going to happen. But don't be, penny wise and dollar foolish, and, give up a nice trade because you wanted to have, a 1 pip stop loss. Yeah, Darius, this is a 30-minute chart. This is a trend following system with one moving average. You can probably do this on a 1 hour or a 4 hour. I really haven't back tested it too much. You may have to adjust the length of the time frame of the moving average to make sure it does this and you capture all of these break points here. But this is a 30-minute. So, but I still consider a 30-minute to be a day to maybe a light swing trading time frame. You certainly can swing through on a 30-minute time frame to another trading day just by holding it. So this is not a scalping time frame certainly, but I would say it's a day to a light swing trading time frame. So Swiss yen and Euro yen, I would not be using this system at all right now, but it's still good. Here's dollar Swiss. It's very good on dollar Swiss. You can see on dollar Swiss, we closed the week up here, all right, with the market turn above. So going into next week, I'm definitely looking for shorts on dollar Swiss just based on this, okay? And look at this, is like beautiful entries. One right here, one right here, one right here, potentially one setting up for next week. All right, so that's the that's it in action. And again, depending what asset, what time frame that you're using, you may have to change the moving average. Again, this is just a 10-period simple moving average on the 30-minute chart. I think is a great synergy, but again, you have to adjust it based on the time frame. So here it is on a 4-hour. If you were talking about a 4-hour, I could see it still working pretty good on here. You know, I might lengthen the moving average a little bit. 10 might be a little short here. Maybe I make it a 20. You know, but this actually is not bad either. So, you know, you can adjust it and tune it based on what time frame you like to use and, you know, just what makes sense. And it might not be the same for every asset too. You know, if you're trading super volatile assets, then you're probably going to have to be a little more generous with your moving average. But at the end of the day, remember, you're using market structure to help you determine trend change. Okay, you're not just using the moving average. You're looking at market structure, major swings, as your trend indicator. Okay, so the moving average is just to help you time your entry, but it's not really designed to help you figure out what direction the market's going in. You should already be able to identify that by an uptrend, higher highs, higher lows, a downtrend, lower highs, lower lows. And when structure breaks, that's when your bias should change, okay? But the moving average is really just designed to help you with timing of entries. All right? Okay, so I'll just quickly jump over to futures. And here's the same thing on futures. And Darius, if you're still looking, this actually is copper. And this is the 30-minute chart of copper. And you can see works pretty well on here too. You know, we've been in this long sustained uptrend. So if you look back here, you know, the market turned from a downtrend here. This first leg of it, based on this time frame and this asset, there would have been no entry until about this point. And then we break below. So there's an entry right here. There's technically another one right here. Now again, here's another stop loss problem. All right, I really want you to like pay attention to these stop loss areas. They're super important. Let's see, where was that? Shoot, I got to zoom back out again and mark that area. You lose track of where you are on the chart. So I think it was like, let's see. Oh, it was over here. Okay. So let me just put a rectangle on this. Okay. So if you look here, and now we'll zoom in a little bit. So we had an entry here. Okay. Then there's another entry right here. All right. Broke below. It's a very small candle, but it broke back anywhere in here where you have these little bullish candles. Another one here. Breaks up, and now you see what happens. They push price down. This is probably a different session. They push price down. They take out anybody that has their stop losses sitting just below here. They wick you out, and then boom, the big move comes. So be very careful again. So maybe instead of putting your stop loss at these lows, find the next structure low, which is down here, and put it here, and you would have been safe. Okay, beautiful entry right here. Right, price comes down. Nice, just nice fat retracement. Okay, still above the last structure area over here. All right, I don't really consider this, even though I have this. This is just one solid candle. This is not really a pullback area. This is okay. And then so we had this big push up, and then this huge move to the upside. Really no entries along the way here. The next one would have been probably here. Okay, again right here. And then we start to roll over. We start to make lower highs, lower lows. And you could trade this down. There's an entry here. And then we break above again. All right. And right here. Now, if you were trading this short, maybe you get in short right here. You're like, okay, here we go. I'm going to take another short. You get stopped out. But you see we failed to put in a new low right here. So after this stop out, I wouldn't have been looking for more longs, more shorts anyways, because it failed to not make a new low down here. It came down, went a little bit, popped right back, and started going higher again. And again, you could also use a longer time frame too to look at this area. Say, you know, what is price doing on, say, up on a 4-hour chart? Okay. Well, on the 4-hour chart, we were still trending up. Okay, we had a structure level put in here, so we're still in a bullish trend on the 4 hours. So you still can use your higher time frames if there's any question about where you're at. But again, long entry here, long entry here, long entry here, long entry here. Okay, and then we come down here. We put in a higher, a lower low and a lower high, and then we have this big drop. So now, for now, we're looking for short. So now we're going to wait for price to, you know, eventually pop back above the 10 somewhere, and then look for a low. Okay, and until again it either fails to put in a new low or we break a major structure point. And the structure point would be the last place where it broke above the moving average with a conclusive, let's say it does it right here, then, you know, this would be structure. So I'd keep looking for that until, let's say now it came down to here, it failed to put in, maybe it came up like this, okay, and then it did something like this, where it failed to put in a new low, it stopped, and now it starts going higher. There's a market change right there, okay? But you do need to be careful, because until it takes out this recent structure right here, you know, you do need to be a little cautious. But chances are this higher low that was put in is the first indication that we could be going higher, okay? So just follow the market structure, look for, you know, failed lows, failed highs, and that can help signal your change of direction. But ultimately, it's a break of structure on that time frame is going to tell you what it's doing. Okay. I don't have it on my DAX chart. I guess we can throw it on natural gas. Let me just clean this chart up first. Did I even put it on here? No. Oh yeah, there it is. Okay. So here it is on natural gas. Again, same thing. This is a pretty choppy market right here, but we have uptrend going, right? So we have a break here. Okay, again, this is another stop loss, you know, reminder. We have price break above. You go long right here, you can see price came all the way back down, retraced. Again, if you had your stop sitting right below this low, guess what? They just knocked you out right here just to see the real move. So again, this is a little weird because there's a big gap in here, but just don't be too conservative with your stop loss, all right? And then price comes down, breaks higher. Again, same thing if you went long right here, because this is a break of the trend line of the moving average. Price breaks up. If you do decide to go long like right here and you put your stop just below here, there they go. They got you again, right? Only to have it gap higher, okay? So again, just be careful of your stop loss. If this is too big of a stop loss, like way down here, because this is the next structure point on this time frame, maybe go down to like a 5-minute time frame and look for a structure break, you know, somewhere in here, okay, and do it that way. Of course, I'm on a 2-hour time frame, but you can see it works anywhere. Go back to the 30, you can see what we've got here. Okay, break, move up, break, move up, okay, and then we'll see. Are we rolling over, or is this going to be another point to enter next week? We'll have to see what happens. All right, and then lastly, all right, this is another one. This is live cattle. This is another one Dario, so not everybody trades. The one thing about live cattle, I've mentioned this on one of my videos. If you're either new to trading, new to futures or trading in general, and or you have a relatively small account, and or you're not profitable consistently yet, do not trade something like cattle. Okay, this is a full Globex contract. There's no micro, there's no mini. Okay, so if you trade one contract on live cattle, this is a 3-hour chart. Let's say you went short, like, I don't know, let's just say you went short on this break right here, right? You go short here, you put your stop above here. From here to here, doesn't look like much. This is probably about, I'm going to guess about $400. Okay, from here to here. So you put your stop up here, you get taken out $400. If you have a decent size account, you certainly, $400 is not going to bother you too much. If you have a $2,000 account, you just lost, 25% of your account. All right. So just be careful. But on the same token, let's put the template on here with that moving average. I can find it. Again, I don't even use these templates, honestly. Okay, so here we go. So now there's your entry, right? So we're trending down, entry right here, entry right here, entry right here. This is not an entry. You've missed the boat. Don't try to chase the market. Wait. If this downtrend's going to continue, we'll make our way down. Then eventually price will break a little bit higher. The moving average will, follow along. Say this is the moving average following along. All right, it'll break, and then we'll get some bearish price action, and price will start to move lower again, and then you take the low. You take the short. It's simple trend following. The moving average just helps you just time the entry. That's all. You're not trading off of a moving average. You're just using the moving average as a guide to help you know where a good place to potentially enter is, because as it gets above the moving average in a downtrend, this area right here is telling you this is a great value. All right, you're selling at a premium above the moving average, and you have a very low risk trade, as opposed to trying to chase market here and putting your stop here and having a huge risk. You see this, price starts to turn bearish back under the moving average. Put your stop here. You only have about 1/3 the risk that you had trying to chase the market lower. Okay, so but again, this is not an asset I would recommend somebody trade if they're new to trading, because there's big money to be lost. Big money to be made if you're right, but there's big money to be lost too. Hey Darius, I don't go on Andre's Discord too much, but certainly happy to chat on there. If you see me that I'm online, although a lot of times I leave Discord open on my computer as long as my computer's on, so it might look like I'm on, but I'm really not. I'm away from my computer. I don't close the application. I leave it open. The only time I close it is when I put my computer to sleep at night. Then obviously it'll show that I'm off. But anyways, if you see me on, send me a DM, and if I'm on, I'm happy to chat. So, all right. So that's live cattle. So you can see you can use it on any of these assets, and it's simple trend following. Like I said, the two things a couple of things to take away: avoid the sideways choppy action. Okay, don't put your stop too close. If the stop loss, I don't advise putting a stop loss just underneath that most recent swing area, because they're probably going to target that area. That's going to be a major liquidity target for the big traders to go and knock you out, and then that's when the biggest moves happen. When they come down and they stop hunt and they sweep liquidity, you can guarantee you a big move is coming, because they need that liquidity to go in the direction they want to go. So if you get stop hunted, guarantee you're going to look back if you're not in front of your chart, and you're going to be kicking yourself, because I guarantee you're going to miss a big move. Okay. So, but if the stop loss is too far away for your comfort on the 30-minute or whatever time frame you're using it on, drop down maybe 2 time frames, 2-3 time frames, find a structure area a little bit further away, but it still qualifies as a structure area on that shorter time frame, and put your stop loss there. Don't be the obvious one where everybody else is putting it, because they know where they are. They know where the retail traders are sticking their stop losses. Okay, they know. All right, and so you want to make sure that you're not going to be that easy liquidity for them, because again, if you don't know where it's the old saying, if you don't know where the liquidity is, you will become the liquidity. Okay. So if you know that they're targeting liquidity just below a recent swing high or swing low, and you put your stop there, guess what? It's high probability you're going to be part of that next sweep. So find the next area above or below that. If you're in a downtrend, instead of that most recent swing high, find the next one above there and target that one. If it's too far away for your comfort, for your risk to reward, go to a shorter time frame and look for it there. Look for a swing on a shorter time. If you're on a 30-minute, maybe drop down to a 10-minute or a 5-minute and look for a swing on that time frame and pick that one. All you have to do is just get a little bit further away from that swing on that time frame you're trading on, where you know they're going to target that, and you should be good. Okay? If it's crazy market conditions and there's some news, you might get stopped out anyways. They may throw a huge wick. You know, you see those like crazy long wicks. There's nothing you can do about that. If you get taken, you get taken, right? There's nothing you can do. It's not going to be perfect. But for the most part, in normal price flow, even with news, just be careful where you put your stop loss. So avoid the ranging markets. And, you know, sometimes it might be hard to tell a range is forming. But if you just look at a chart and you see the moving average like here cutting through price, this is a ranging market. Just stay away from it until price starts to clear up again. Don't put your stop loss too close, and watch for changes in direction. And changes of direction can happen either from market shifts, like we were going up here, then we come down, we form a higher low, okay? So maybe you go long right here, okay? And you might take a loss here, right? But because you've recognized now that the moving average is pointing down, you took a loss, now you change your bias to downside, and you can get ready for the next entry. All right, at some point things are going to shift. So there's a structure change right here, okay? And maybe you see this structure right here and you're like, you know what? I'm not gonna trade this long anymore anyways, because there's structure sitting right here and price wick through here. And I prefer to see a candle body, but still they managed to push price below this swing right here, and this is a valid major swing point. And then they pushed it up, and then here's your warning sign, right? It pops above the moving average and just throws a doji candle. If I was in this long and I saw a structure break, and I took a long, and then this close above the moving average throws a doji, there's no movement to go to the upside, I would have closed this right here or somewhere in here. As soon as I saw this bearish candle forming, I would have been out. So, like, that's a huge warning sign. So, right? So that's what you want to make sure of. So that's how you can, again, the moving average is not going to help you in this case, right? You're using market structure. That's all. So pops through, comes back, you enter long. I'm just trying to be, real, because in real time, you would have said, okay, we're still in an uptrend. At this point, you still think we're going up. We come down, we break below. We have two solid bullish candles closing at their highs. But then the one that breaks above the moving average there's nothing to it. There's nothing. It's dead. It's a dead candle, right? It barely got through, and it came back and closed right on the moving average after following a trend, a structure break. Huge warning sign. So hopefully, that just comes with experience. But if you suffer a stop out, then so be it. So, all right. But this is copper, by the way. So it's good, So. It's a good market to trade. It does like to go into consolidation. If you scroll back and you look, when it does consolidate, it likes to sit in consolidation for a while, like back here, right here. It does like to sit in consolidation for several days after it makes a big run. But when it does trend, it's really clear and it's easy to follow it. So, and you follow along. And that's why the 30-minute is nice, because you can always use the 4-hour as your trend confirmation. So, you can just kind of follow along with it. So that's why I like copper. And that's why I stay away from things like NASDAQ and S&P and Dow and all gold and all that stuff. I don't trade them. Oil. I used to trade oil. Even natural gas is a little dicey, but it's not as like retail heavy as crude oil. So, but anyways, yeah, so I'm going to leave it there. So again, 30-minute chart, 10 period simple moving average. Still use your market structure. Don't rely on the moving average to tell you that kind of stuff, because remember, moving average lags. It's just a way of helping you time entries and find good value, high value areas to enter. That's all the moving average does. You don't even need it. I mean, once you get good at reading market structure, you can take the moving average off and you can just do it without it. But it's a nice little crutch, and there's nothing wrong with it. If it helps you and you need that visual, then go for it. I mean, I still use it. If I trade this, if I'm not seeing a lot going on the higher time frames, but there's a trending market, I will use this methodology on the 30-minute so I can find a trade. Okay, because if you're up on the 4-hour or higher, you got to wait for those times when price pulls back into a major zone. You could go days without a trade, and that's fine. There's nothing wrong with that. You don't want to overtrade anyways. But if the market's clearly trending and there's an entry, you're missing something, then maybe you go down to something like a 30-minute chart and use this methodology on there. And it's just another way of following that trend without having to wait for a big pullback on, say, a 4-hour chart. So that's all. But like I said, you can use this on the 4-hour too. You're just going to have, you just may have to tweak your moving average length, and but just follow the market structure. It's pretty much, I just keep coming back to that, but that's the way it is. So anyways, hey, Dario's futures GOAT. Yeah, I don't think so, but I appreciate it, man. I'm just trying to do my part. That's all. But anyways, glad you liked it. Probably end it there unless there's any other questions. This will be posted obviously on my YouTube channel. So if you're seeing this afterwards on the recording, cool. Make sure you, as always, hit the like button, subscribe to the channel, leave questions and comments if you have any. And, I appreciate it. So, yeah, Darius, I'll catch you in the Discord. Like I said, if you see me in there, any questions, you want to chat, if I'm available, I'm happy to jump on audio. I don't think I've done that. Well, I think I did it once with Andre. He was just hosting like a general chat. I jumped in there for a few minutes, but I didn't stay very long. I don't know what they were talking about. So, but, everybody's got their opinions on trading and setups, and it's good to, that the thing is for me, I'll just tell you that, the issue is if you listen to too many people, especially if there's all different methodologies and all different strategies and all different time frames and all different assets, you're just going to confuse the piss out of yourself. And, so I do tend to just filter out all the noise. I do watch a lot of stuff on YouTube. I love to see what other people post for trading, but I hardly ever take anything from it because this is what works for me. It may not work for somebody else, but it works for me. This is what I've gravitated to. I've tried a million different things. I've tried everything. I've been trading a long time. I've tried just about everything you can think of. You can probably name anything I can tell you. I've probably tried it. Hundreds of different indicators, different strategies, different way of looking at candles, Heikin-Ashi smooth, Renkos, everything. And this is what I end up gravitating back to. Simple price action, maybe one indicator, and that's it. So that's part of the reason why I don't get too much involved, because I'll tell you my opinion about what I think about a particular asset, but at the end of the day, it doesn't matter what I think. It's what works for you. It's what you think, and it's just my opinion. It's just the way I look at it. Somebody can look at the same chart and have a 180-degree total opposite opinion about what they think that's going to do based on how they trade, and that's perfectly fine. And it can also vary on the time frame. I mean, obviously it's a completely different picture a lot of times if you're trading on a 5-minute versus a 4-hour. You could have a huge downtrend going on the 5-minute, on the 4 hour is nothing but a little pullback. And so that's the thing. So, so that's it. So don't get too clouded listening to too many different opinions. Do whatever feels right for you, whatever resonates with you, whatever time frame it's on, whatever asset it is, whatever system, methodology, whatever it is. If you find something that works, stick with it. Don't get watered down by everybody else, because it's just going to confuse you, and you're going to end up, getting into that cycle of doom of using too many different things, and at the end of the day, it's not going to help you. It's only going to hurt you, because you're not going to be able to master the system that resonates with you, because you're going to be looking at the grass is always greener with somebody else, and that's not the case. So anyways, so enough said. I'll leave it there. Hope everybody has a great night. If you're watching this later, appreciate it. And Darius, I appreciate you jumping on, and I'll catch you in the Discord. Everybody, have a great night and a great weekend, and I'll talk to everybody soon. All right, take